Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at IBM.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices and want clearer buy and sell signals, you can check out VIP indicators through my link below. Grow $100 to $10 Ks with VIP indicators.
Right.
VIP indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate. The tools are designed to help traders spot possible setups faster and trade with more confidence. But please remember, trading is risky. No indicator can guarantee profits, and growing $100 into $10 is not guaranteed.
Exactly. Always be careful.
Use these tools for education and analysis only, manage your risk carefully, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
All right, so imagine having just like the absolute best quarter your company has seen in 10 years. You completely crush all the Wall Street expectations, your underlying business is firing on all cylinders, and your reward.
Right, a massive sell-off.
Exactly. The market immediately slashes your value by 10%. That is the central mystery we are looking at today with IBM. I mean, this isn't some hypothetical scenario.
No, it's playing out right now.
Yeah, we're talking about operating diluted earnings per share surging 19% to $1.91. That entirely blew past the analyst consensus of $1.81, I think.
Yeah, a huge beat.
By every traditional metric, it was a fantastic quarter. Yet the moment that earnings report dropped, the stock just plummeted 8 to 10%. And looking at the broader picture, it's down over 22% year to date.
Which is wild, honestly.
It really is. And as someone who analyzes market behavior, this sets off alarm bells for me. Usually market reactions do not lie. If the earnings were such a crushing beat, why is the market punishing the stock so severely?
Well, it really is the ultimate puzzle right now, right? And the answer lies in the mechanics of how the market trades versus how a business actually operates on a day-to-day level.
Okay, so disconnect.
Huge disconnect. What's fascinating here is that we are witnessing a massive fundamental inflection in enterprise artificial intelligence adoption. But Wall Street momentum traders they're just completely mispricing it.
Because they're looking for short-term gains.
Exactly. Momentum traders often use algorithms that buy or sell based on immediate gratification.
Yeah.
Specifically, they look for management to actively raise their full-year financial guidance.
Ah, and they didn't do that.
Right. When management maintained their guidance instead of raising it, those algorithms triggered a massive knee-jerk sell-off. The market essentially threw a tantrum.
A very expensive tantrum.
Totally. But if you look under the hood at the actual execution, the long-term enterprise AI thesis is playing out perfectly. The market is pricing this as if it were some, legacy tech dinosaur losing steam.
When the underlying data says something else.
Exactly. The underlying data shows a company successfully transitioning into a high-margin, hybrid cloud, and AI powerhouse.
Wow. Okay. But when we see a massive, emotionally driven sell-off like that, it's very easy to panic. But to really understand if this presents an opportunity for your portfolio rather than just, catching a falling knife. All right, let's move into the wealth building context.
Let's do it.
Because looking at this from a practical, long-term perspective, this isn't just a quick momentum trade you hold for a week. There is a serious dividend and yield story here that acts as an anchor for the whole thing.
A huge anchor, yeah.
We are talking about a 31-year consecutive dividend growth streak. 31 years of uninterrupted increases. I mean, they are currently paying $1.69 a share quarterly.
Which puts the yield well over 3.5% at current prices.
Exactly. Which is incredible for tech.
And that's exactly why this fits so beautifully into a long-term wealth strategy. If you are constructing a resilient portfolio, this is a classic accumulation play. Think about the current market environment for a second.
Very speculative, right?
Very. You have a lot of unprofitable growth tech companies out there. Companies that, promise you the moon, they slap AI on their pitch deck, but they burn through millions in cash every single quarter.
Yeah, we see that all the time.
Right. But a stock like this provides a highly reliable cash flow buffer against that volatility. We are looking at a financial trajectory that targets $21.87 billion in free cash flow by 2030.
Almost $22 billion in cash.
Actual cash. When the broader tech sector gets volatile and speculative multiples compress, that robust dividend safety acts as a shock absorber for your entire portfolio.
But that raises an important question for anyone analyzing this space. A technology company with deep AI exposure and a yield over 3.5%, that is an incredibly rare profile.
It's basically a unicorn right now.
It really is. It
Yeah.
almost feels like a contradiction in modern finance. Usually you have to choose, right? You either get the hypergrowth AI narrative with zero yield, or you get the sleepy, high-yield legacy dividend player that barely grows at all.
The utility stock model, yeah.
Right, so getting both makes me very analytical and, frankly, a bit cautious about the underlying risk. I mean, is this a hidden gem that the market is just completely sleeping on? Or are we looking at a classic value trap where the yield only looks mathematically great because the underlying stock price is just collapsing?
I get the skepticism, but it is genuinely a hidden gem, and the free cash flow trajectory is the ultimate proof of that. A value trap is when a company takes on, like, toxic debt just to keep paying a dividend they can no longer afford.
Right, they're borrowing to pay the yield.
Exactly, which is a death spiral.
Oh.
But here, they are funding that dividend with highly predictable, recurring revenue from essential enterprise infrastructure. The cash is real, and the business generating that cash is actually growing, not shrinking.
Okay, so you mentioned this massive cash flow anchor. And to really trust that anchor in your portfolio, we need to open up the hood and see exactly where that cash is actually coming from. Now let's look at the fundamentals.
Yeah, let's break it down.
In the first quarter of 2026, total revenue hit $15.9 billion, which is a solid 6% year-over-year growth at constant currency. But the breakdown is where it gets super interesting.
Oh, absolutely.
Software grew 8%, and within that, data revenue surged 16%. A lot of that surge is being driven by generative AI products and the early closing of their Confluent acquisition.
Which was a huge strategic move.
Definitely. Plus, Red Hat OpenShift just crossed a massive milestone, $2 billion in annual recurring revenue. And here's my sticking point. Then we look at the balance sheet, and I have to admit, it gives me a bit of vertigo.
A debt load?
Yeah. We have $66.4 billion in debt,
Yeah.
which just went up $5.1 billion specifically to buy Confluent, and that's sitting against just $11.8 billion in cash. That is a highly levered balance sheet for a technology company.
It is levered, absolutely. You can't deny that.
Really?
But we have to understand the why and the how behind that leverage. They aren't borrowing money to keep the lights on or pay the electric bill.
So what are they doing with it?
They are utilizing strategic debt for transformational mergers and acquisitions.
Yeah.
You have to weigh that $66 billion debt load against their massive cash generation engine.
Okay, fair point.
In the first quarter alone, free cash flow was a record margin, $2.2 billion. That is a 13% year-over-year increase. When you have an engine producing that much cash, using strategic debt to acquire high-growth software companies like Confluent, it makes perfect business sense.
It's fuel for the fire.
Exactly. And it is showing incredible operating leverage right now. Their adjusted EBITDA, which is essentially a measure of their core operating profitability before taxes and accounting factors, that grew 17% to $4 billion.
Wow, 17% EBITDA is no joke.
Right. By strategically acquiring these software platforms, they're shifting their entire business mix toward high-margin software. And you can see those profit margins actively expanding as a result.
I see the mechanical argument for the leverage, but I want to talk about the competitive moat for a second, specifically regarding AI, because everyone is talking about the public cloud right now.
Oh yeah, the hyperscalers.
Right. What I find really fascinating here is their pivot to what they call the sovereign core and the watsonx platforms. It's essentially a walled garden for enterprise data.
Yes, which is so critical right now.
Think about it. Enterprises desperately want the efficiency of AI, right? But they are terrified of data breaches and regulatory fines. If you are a major bank, a defense contractor, or a healthcare provider, you simply cannot dump your highly regulated proprietary customer data into a massive public cloud AI model where it might get exposed.
Exactly. And that is where the brilliance of the sovereign core strategy comes into play. Think of a public AI model like a massive public library. It's great for general knowledge, but you would never leave your personal diary open on the reading table.
No, absolutely not.
Right. So IBM Sovereign Core is like building a supercomputer directly inside a bank's own personal, heavily guarded vault. They are providing AI governance and data security that public hyperscalers simply cannot easily replicate.
So they're targeting the highly regulated sectors.
Yep. Financial institutions are upgrading to the new Z17 mainframes specifically so they can run AI inferencing on 100% of their daily transaction volume without ever moving that proprietary data off the platform.
That's incredible. So the AI comes to the data, not the other way around.
Precisely. And think about the switching costs for a moment. Once a major bank tightly integrates their core transaction engine with on-platform AI inferencing, they are never leaving. It completely insulates them from being locked into a competitor's public cloud.
So if they have this impenetrable bank vault for enterprise data, the obvious question is, when does the rest of the market wake up to it? That brings us to the catalyst timeline.
The events to watch, yeah.
Exactly. What are the near-term events over the next 3 months that could actually move the needle and force Wall Street to realize the value of this sovereign AI narrative?
Well, the first major catalyst event to watch is Q2 earnings, which are estimated for mid-July 2026. The street is going to be laser-focused on one specific metric, and that's the software segment.
To see if the acquisitions are paying off.
Right. They need to see if it hits that guided 10+% growth rate. If software accelerates as promised, it fully validates the entire high-margin transition thesis we've been discussing today.
What about outside of earnings?
Beyond the earnings report, we have the fallout from the Think 2026 conference, specifically the global commercial rollout of the Sovereign Core product. That is when we will start seeing actual customer adoption numbers for this secure AI framework.
And there are some really fascinating kind of under-the-radar research and development wins happening right now that aren't grabbing the huge headlines but are structurally massive.
Oh, like the internal tools?
Yeah. They have this in-kernel AI tool called Bob that is reportedly driving 45% developer productivity gains. Just imagine making half of your software engineering workforce almost twice as fast.
It's game-changing for their margins.
It really is. Plus, the new MIT IBM Computing Research Lab is aiming for quantum AI breakthroughs by 2027. Those are the kinds of long-term technology seeds that eventually blossom into massive commercial advantages.
Absolutely.
But we also have to consider the broader macro tailwinds, too. If we see a stabilized interest rate environment, or if the broader market gets jittery and decides to go risk off, capital naturally flees highly speculative tech and seeks safety.
Right, the flight to safety.
Exactly. A high-yielding stock with a massive proven cash flow engine becomes a magnet for that capital, especially when you factor in that the generative AI server market has a 34% CAGR, that's a compound annual growth rate forecast out to 2030. That is steady, compounded growth year after year.
That macro environment is the perfect storm for a solid infrastructure play like this. The physical infrastructure demands for generative AI are not slowing down. If anything, they are accelerating.
It's just picking up speed.
Yeah. Eventually, capital will stop chasing the flashy consumer apps and start rewarding the companies actually building the picks and shovels, the secure, compliant servers and data pipelines that make enterprise AI possible in the first place.
But even with those massive macro tailwinds on the horizon, if you look at the stock today, the technical damage is severe. Now let's pivot to the chart.
Yeah, it's a bit ugly right now.
It is. Because the price structure right now is frankly alarming from a short-term perspective. Following that earnings report, the stock fell all the way from the mid-280s down to the 229 to 234 range.
Which is quite the haircut.
Yeah, and that puts it dangerously close to its 52-week low of $220.72. It completely failed to hold the post-earnings gap, which essentially flushed out all the short-term momentum traders who were banking on a guidance raise.
It looks alarming. But honestly, that violent flushout is exactly what creates the opportunity for a patient investor. This is where we see a fascinating anomaly, a massive divergence signal in the quantitative data.
Okay, break that down for us.
Right now, the momentum score has absolutely plunged. It sits at 8.88, which drops it into the bottom 10% of the entire market.
Wow, the bottom 10%.
Yeah, but the fundamental quality score remains sky high at 81.75.
So let's unpack the mechanics of that divergence. Why should you, as an analytical investor looking at your screen, care that the momentum score is in the basement while the quality score is in the penthouse? What does that actually mean for the price?
Think of the stock price right now like a heavily stretched rubber band. When momentum collapses, but the fundamental quality of the business stays elevated, it frequently creates a classic setup for a mean reversion bounce.
A snapback.
Exactly. The quantitative metrics are telling us that the business itself is operating exceptionally well. I mean, they are generating billions in cash, expanding their profit margins, and growing their key software segments.
But the stock chart doesn't show that.
Because the short-term trading sentiment has completely detached from that reality. The momentum traders dumped the stock en masse because they didn't get their immediate gratification. But eventually, those traders run out of shares to sell.
Right.
The selling exhaustion hits, the dust settles, and the stock price snaps back to where the actual fundamental business value says it should be.
So if the technicals are basically a stretched rubber band waiting to snap back, how are the big institutional players reading the room? So what does market sentiment look like?
It's shifting.
Because right now, the immediate post-earnings mood feels very bearish on Wall Street due to that flat 2026 guidance.
Main Street retail traders might be panicking, sure, but institutional sentiment is actually quietly stabilizing. We are already seeing the big players step in with upgrades.
Oh, really? Like who?
Well, HSBC recently upgraded the stock to hold, specifically noting that the post-earnings valuation drop makes the stock incredibly, quote, reasonable. And if you look at the broader consensus targets from analysts, they are sitting between $293 and $297.
Okay, so if those targets hold, that implies roughly 25% upside from current levels.
Precisely. And we also have to look closely at institutional moves, specifically from the management team. The decision to aggressively raise $5.1 billion in debt to buy Confluent is a massive signal.
You mean a signal of confidence?
Yes. You do not leverage your balance sheet like that unless you are highly confident in your ability to pivot your software stack toward real-time data streaming and, actually generate a massive return on that capital.
That makes sense. But the daily news flow is incredibly mixed right now, which I think is causing a lot of confusion for investors.
Yeah.
On one hand, you have retail endorsements, like you have TV personalities like Jim Cramer explicitly saying buy.
Right, the retail hype.
But on the other hand, there are real institutional governance risks making headlines. Specifically, there is an active ESG lawsuit regarding executive layoffs.
Right, and strictly from a market sentiment perspective, we have to look at how funds process that mechanically. That ESG lawsuit, which falls under environmental, social, and governance criteria, it introduces a governance risk factor that can weigh heavily on institutional investment mandates.
Because they have strict rules.
Exactly. Many large pension funds and institutional portfolios have strict ESG criteria they must legally follow. Litigation in this space can act as a temporary ceiling on institutional inflows until that governance risk is fully resolved or clarified in court.
Right, and to be clear, we are just looking impartially at how the market mechanically processes that risk factor, not making a judgment on it.
Absolutely. It's just a variable in the sentiment equation.
There is also a speculative rumor circulating right now that Anthropic might be displacing Watson X in some specific enterprise use cases. Now, that is completely unconfirmed, but it adds to the general market noise and the fear that perhaps the legacy giant is losing its grip on the rapidly moving frontier of AI development.
Which is a valid fear for investors to monitor, for sure.
Mm.
However, if they can successfully integrate open source model competition directly into their secure sovereign core environment, rather than trying to stubbornly build every foundational model themselves, that AI displacement fear is likely overblown.
Because the value is the vault, not the specific model.
Nailed it. The true long-term value for enterprises is in the secure, impenetrable infrastructure vault, not just having the flashiest specific language model of the month.
Okay, so we've covered the debt, the AI transition, the technical flesh out, and the sentiment. But we can't just look at the rosy projections without stress testing the foundation. Now let's talk about the risks.
Always the most important part.
Because my cautious analytical side is looking straight at their consulting segment, and it looks like a glaring red flag. We saw just 1% growth in consulting.
Yeah, that's weak.
That stagnation is a massive drag on overall margins because consulting inherently has much lower margins than software licenses. And the real structural fear here is AI cannibalization. Are AI native startups actively stealing market share in enterprise digital transformation?
This is the big question.
Are we watching the legacy human-driven consulting model slowly bleed out because AI can just do the job faster?
That right there is the most common bear argument on Wall Street. But it fundamentally misunderstands the mechanics of what is actually happening under the surface of that specific segment.
Okay, how so?
Yes, the 1% growth today looks weak on a spreadsheet. But look closely at the backlog. 30% of that massive consulting backlog is now generative AI projects.
30%? That's huge.
Right now, they are mostly in the early pilot phase, which doesn't generate huge revenue immediately. But as those pilots mature, prove their worth, and scale into real production deployments across entire global enterprises, they act as a Trojan horse.
Oh, I see. A foot in the door.
Exactly. You start with a small consulting pilot, and once the enterprise loves it, it naturally pulls through the high-margin software licenses like Watson X and Red Hat OpenShift required to run it globally. The revenue mix is naturally going to shift as those initial consulting hours convert into highly profitable, recurring software revenue.
Okay, I hear that explanation for the software pull-through, but I have to push back hard on the infrastructure numbers we discussed earlier. We celebrated a 48% growth rate in Z mainframe sales.
Yeah, massive growth.
Now, it's incredible that they are moving that much hardware, but it is undeniably hardware cyclicality. It is a temporary spike. It is completely unsustainable. They are going to face incredibly tough year-over-year growth comparisons very soon.
It's true. The cycles always peak.
Right. So isn't there a severe risk that this temporary hardware bump is simply masking a secular decline in other areas of the business? When the mainframe cycle eventually cools down and decelerates, won't the entire growth narrative collapse with it?
That is a brilliant question, but answering it requires us to look at exactly how management is allocating the capital generated from that cycle. Yes, mainframe sales are inherently cyclical. But first, this Z17 cycle is just entering its prime installation phase. These are multi-year enterprise upgrade cycles.
So it's not ending tomorrow.
No. But far more importantly, look at what they are actively doing with the cash generated by this hardware supercycle. They are using that massive influx of temporary, cyclical hardware cash to buy permanent, secular software growth.
Ah, like the Confluent deal.
That is exactly what the Confluent and HashiCorp acquisitions are all about. They are strategically capturing the massive windfall from the mainframe upgrades and using it to permanently expand their high-margin, recurring software portfolio. It is a masterful capital allocation strategy that smooths out the hardware cycles over the long term.
Okay, wow. We've thoroughly stress-tested the bear case, we've unpacked the consulting backlog, and we've examined the mechanics of the mainframe cycle. So with everything on the table, what's the final verdict?
Let's summarize it.
Because we have a stock sitting on a 22% year-to-date drop, offering a very high yield, generating record free cash flow, but also dealing with severe momentum damage and consulting stagnation.
The underlying research assigns this a bullish score of 8 out of 10. If we had to boil this down, the core thesis is this. The 22% year-to-date drop is a classic textbook market overreaction.
So the market got it wrong.
Wall Street algorithms are obsessing over short-term consulting softness and completely misunderstanding the hardware upgrade cycle. Meanwhile, they are entirely ignoring the $2.2 billion in first-quarter free cash flow and the massive generative AI consulting pipeline that is waiting to convert into lucrative software licenses.
Right, and when you combine the fact that OpenShift just crossed $2 billion in annual recurring revenue, and the sovereign AI pivot is giving highly regulated enterprises exactly the security they need, the broader thesis is that this company has positioned itself as the essential secure hybrid bridge for real-world AI deployment.
Exactly. Based on that, the final stance here is a multi-year hold. If you were looking at this, you should be looking at a 1 to 3 year horizon.
So definitely not a day trade.
No. You want to capture the full deployment of the Z17 mainframe cycle and watch that huge generative AI book of business successfully convert into highly profitable software revenue. It is a fundamental inflection point that the technical chart simply hasn't realized yet.
And if you want extra help reading trading charts, you can check out VIP indicators through the link below. The campaign is grow $100 to $10K with VIP indicators.
Right.
And their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate. But trading always carries risk, and no profits are guaranteed.
Exactly.
Use the tools for education and analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.